If you're patient, investing can be really simple. Buy low, sell high. Buy fear, sell greed. Maybe put money into a mutual fund, an index fund, an ETF, or a REIT. Never touch it. Keep investing into it at whatever cadence you need to, monthly, bi-weekly, etc. Keep investing into it at whatever cadence you need to, monthly, bi-weekly, etc. And if you manage to do that, well, you, sir or madam, are set for a great retirement. At the very least, you're set up with a nice existence with that cash that you've saved, skulked away in an investment of your choice. That said, if you're a sucker for punishment, investing can be really complex. In this video, we're going to go over not so common investment instruments and how they can help or hurt your portfolio. What's up, guys? You're watching BTP Fusion. I'm your lovable, affable, bearded host, Derek West. If this is your first time here, welcome. I think you'll like it. If you're back, glad to have you. You know how we do it over here. In any case, let's dive right in, shall we? If you've ever spent more than a few minutes browsing CNBC.com, you may have come to the conclusion that the investment landscape can be extremely dynamic and ever evolving. You may wonder to yourself, how is it that people are able to navigate through all the myriad of options available to them and make money with their investments? Another question that may cross your mind, is there some secret knowledge that these folks possess that the rest of us just don't have that give them an advantage? Short answer, yes. Yes, there is. Long answer, if you take the time to understand the basic principles and the different asset classes that you have access to, you could stand to gain significantly over the long haul. The first step, as with many things, is education. Learn to distinguish different types of investments and what rung each occupies on the so-called risk ladder. What is the said risk ladder? Well, the risk ladder is really a stratification of all the different types of investments that you could possibly make, with the lowest rung of that ladder being the least risky, and with the highest rung being the most risky type of investment. Let's go over just a few of the simple ones, shall we? Cash. Now, it doesn't get much simpler or risk less than cash. It is the least quote-unquote risky of all the different types of investments in some minds. If you place your cash in a checking or savings account, the investor in said checking or savings account has the precise knowledge of the interest rates they'll earn, and they also have a guarantee that they'll get their capital back if their bank is FDIC insured. The only downside or risk that we know of is if your bank is not FDIC insured, it could go bust. And also, we talk about this quite a bit here on BTP Fusion, the interest earned from cash socked away in a savings or checking account seldom beats inflation. Cash and certificates of deposit have higher interest rates, but they're not as liquid as other cash investments. So that money is locked up for a period of time, and there could be early withdrawal penalties involved. A bond, the next safest type of investment, is a debt instrument representing a loan made by an investor to a borrower. A typical bond will involve either a corporation or a government agency where the borrower will issue a fixed interest rate to the lender in exchange for use of their capital. Bonds are commonplace in organizations that use them in order to finance operations, purchases, or other projects. Bond rates are essentially determined by the interest rate. Due to this, they are heavily traded during periods of quantitative easing, or when the Federal Reserve or other central banks raise interest rates. The next rung higher, stocks. Shares of stocks let investors participate in the company's success by an increase in the stock price and also through dividends. Shareholders have a claim on the company's assets in the event of a liquidation. That is, if the company goes bankrupt, but they do not own the assets. Holders of common stock enjoy voting rights at shareholders' meetings. Holders of preferred stock don't have voting rights, but they do have perceived preference over common shareholders in terms of the dividend payments. Mutual funds are next on the list. A mutual fund is a type of investment where more than one investor pools their money together in order to purchase securities. Mutual funds are not necessarily passive, as they are managed by portfolio managers who allocate and distribute the pooled investments into stocks, bonds, and other securities. Individuals may invest in mutual funds for as little as $1,000 per share, letting them diversify into as many as 100 different stocks contained within a given portfolio. Mutual funds that are designed to mimic underlying indexes, such as the S&P 500 or Dow Industrial Index, are considered index funds, the favorite of such YouTube celebrities as Graham Stephan. There are also many mutual funds that are actively managed, meaning they are updated by portfolio managers who carefully track and adjust their allocations within the fund. That said, these funds generally have greater costs, such as a yearly management fee and front-end charges, which can cut into an investor's returns. Mutual funds are valued at the end of the trading day, and all buy and sell transactions are likewise executed after the market closes. Next up, we have ETFs. ETFs are similar to mutual funds, but they trade throughout the day on stock exchanges, so they mirror the buy and sell behavior of stocks. This also means that their value can change drastically during the course of a single trading day. ETFs can track an underlying index such as the S&P 500 or any other basket of stocks the issuer of the ETF wants to underline a specific ETF with. This can include anything from emerging markets, commodity, individual business sectors such as biotech or agriculture, and many more. Due to the ease of trading and broad coverage, ETFs are extremely popular with your average retail investor. That said, the risky side of this is that many investors are beginning to point to ETFs and index funds, frankly, and say that they are in fact inflating the stock market due to their ease of purchase and use. Michael Burry, of Big Short fame, who famously called the housing crisis and crash of mortgage-backed securities, is one of these guys. Take that for what it's worth, but there are some criticisms and legitimate fears that ETFs and index funds are inflating the value of the stock market, and when the stock market inevitably goes down, may have a large influence in the cause of that. Next up, we have ETFs. Next up is forex. Forex is a portmanteau. Portmanteau? I don't know how to pronounce that, dude. Forex is a combination of the words foreign currency and exchange. Foreign exchange is the process of changing one currency into another currency for a variety of reasons, usually for commerce, trading, most likely tourism. According to a recent triennial report from the Bank of International Settlements, a global bank for national central banks, the average was more than $5.1 trillion in daily forex trading volume. That's a ton of cash. You may suspect, but I'll confirm, currency trading was very difficult for individual investors prior to the revelation of the internet. Most currency traders were large multinational corporations, hedge funds, or high net worth individuals. This was because forex trading required a lot of capital. With the help of the internet, a retail market aimed at individual traders has emerged, providing easy access to foreign exchange markets, either through the banks themselves or brokers, making a secondary market. Most online brokers or dealers offer very high leverage to individual traders who can control a large trade with a small account balance. So, there are two distinct features to currencies as an asset class. You can earn the interest rate difference between two currencies. You can profit from changes in the exchange rate. An investor can profit from the differences between two interest rates in two different economies by buying the currency with the higher interest rate and shorting the currency with the lower interest rate. Prior to the 2008 financial crisis, it was very common to short the Japanese yen and buy British pounds because the interest rate difference was very large. This strategy is sometimes referenced to as a carry trade. Is your head spinning yet? Yeah? Well, get out the Advil, as those were the simple types of investment instruments. I'm sure you noticed, the complexity of the asset class increased as we went on. Keep that in mind, because so does the riskiness of the asset class. Now you're going to want to click that like button and that notification bell, because next time on BTP Fusion, we're going to dive into complex investment instruments. Stay locked in.